When talking about the financial markets, you probably have heard at one point the terms risk on and risk off. These terms describe the two most important phases financial markets can have, and if you want to become a profitable trader and investor, it is essential that you understand these two terms and which assets to prefer when the sentiment changes from risk on to risk off and vice versa. Hi, my name is Dirk. I've been a trader and investor for 25 years, and it is my job here at PrimeXBT to teach you how to navigate the financial markets more safely and effectively. Before we start, do me the favor and press that like button plus subscribe to the channel so you will get notified about upcoming videos and live stream that will help you to become a better trader. The financial markets are one of the most complex puzzles out there, and arguably also one of the most difficult to crack, especially when it comes to short-term trading, like for example scalping and day trading. But as complex as they are, there are actually only two main phases markets usually can take: risk on and risk off. Understanding what happens to the markets during these phases is, in my opinion, crucial to helping you to pick the right assets and directions for your trades, especially when being more of a short-term trader. But let's start in the very beginning. Risk on. This term is used when investors are willing to take on more risk in hopes of achieving higher returns. During risk-on periods, investors tend to buy higher risk investments such as stocks, commodities, high-yield bonds and currencies of emerging markets. This is often because they feel optimistic about the economic outlook and are willing to take on more risk for the potential of higher returns. An example for this is the extremely low interest rate environment we had in a lot of the established world economies from around 2009 to 2020, with interest being almost at 0% or having negative yields from investing in assets such as government bonds. Most investors decided to accept more risk in exchange for the chance of a higher return on investment by putting their money in, for example, the stock markets. This, for example, resulted in the S&P 500, the most important stock index in the world, rising by over 400%, not to mention, of course, the fabulous returns investors made with Bitcoin. Risk off. On the other hand, risk off describes periods when investors are looking to reduce risk. This typically happens during times of economic uncertainty or instability. In risk-off periods, investors tend to sell higher-risk assets and move their money into lower-risk investments, such as government bonds, gold or the US dollar, which are seen as safe havens during turbulent times. A good example of this is the development of the stock and cryptocurrency markets in 2022. With suddenly worsening economic conditions such as high inflation rate, sharply rising interest rates, and a looming recession, market participants switched from assets such as stocks and cryptocurrencies to investing in US Treasury bonds, gold, and the US dollar in general. They basically opted for the safe 4% in yield from a US government bond rather than the unsafe 8% return on investment they would get on average per year from the stock markets. Now, I know what you might be thinking. Dirk, with the super high debts the USA have accumulated over the last 30 years, can you as government bonds really be considered as a safe investment? And you're absolutely right to ask this question, but as long as they are still perceived as safe by most market participants, the laws of what performs in risk-on and risk-off periods still apply, and as traders we should not try to stand in the way of a colossal wave of money that shifts between assets. As traders, you sometimes have to pick the positions that actually go against what you fundamentally believe. And believe me, I had to learn this the hard way, yes. So better set aside your ego and trade what you see, not what you believe. Now that we know that, simply spoken, during risk-on periods, long positions in stocks and cryptocurrencies tend to perform better, and vice versa short positions in risk-off periods, we should incorporate these findings into our trading plan. To build an opinion on whether we are in a risk-on or risk-off period, I personally look at 3 charts. The DXY, also known as the US dollar index, is a measure of the value of the United States dollar relative to a basket of foreign currencies. It is a weighted geometric mean of the US dollar's value compared to other major currencies. The DXY is often used as a barometer for the overall strength of the US dollar. When the DXY goes up, the US dollar is stronger compared to other currencies. When the DXY goes down, the US dollar is weaker compared to other currencies. As we can see, since its heights in Q4 of 2022, the US dollar has lost strength against the other currencies in the basket. This is a telltale sign of a risk-on market. The S&P 500 or the Standard & Poor's 500 is a stock market index that measures the stock performance of 500 large companies listed on stock exchanges in the United States. It is one of the most commonly followed equity indices and is considered to be one of the best representations of the US stock market. The S&P 500 index includes companies from all sectors of the economy, making it a good indicator of the overall health of the US economy. Looking at the same period of price development that we just looked at for the US dollar index, we can see that the S&P 500 had actually a very positive return for that period of time, rising from around 3,500 points to almost 4,600 points. This is a sign of a risk-on market. The term US 10Y refers to the 10-year United States Treasury note. It's a debt obligation issued by the US Department of the Treasury with a maturity of 10 years. The 10-year Treasury note is one of the most closely watched government debt instruments, as it is used as a benchmark to set interest rates for various types of loans, including mortgages. The yield or interest rate on the US 10Y is a key economic indicator and is closely watched by investors, economists and policymakers. As we can see, during the time period we are watching, the yields, so the average return on investment you got from this asset, has somewhat moved sideways. However, this being in an environment where the Fed raised interest rates 10 times in a row can be somewhat considered as risk-on. However, since we want to keep it more simple here today, I would consider this chart currently as neutral. Two clear indications of risk on markets, one more neutral indication. I think we can come to the conclusion here that the financial markets are currently in a risk-on phase. However, this does of course not mean that everything risk-on, such as stocks and cryptocurrencies, go up in a straight line. As you can see here, there are also short periods in between where the sentiment seems to switch back and forth between risk on and risk off. So it's very important that you adapt the time horizon you are viewing to the time horizon you are trading in. If you are more of a swing trader who holds onto positions for periods of just 1 to 2 weeks, it of course does not make sense to use super long-term charts of the 3 previously mentioned assets to decide if the current markets are in a risk-on or risk-off period. You need to also use shorter time frames here. However, if you are, like myself, a more long-term investor, you might look also at more long-term charts to decide on your positioning. I just recently mentioned, for example, in our Academy group, which you can access for free by the way using the link below this video, that I might be looking for more long-term positions in Bitcoin between the area of 28,500 US dollars and 29,000 US dollars. This decision, for example, took account of my long-term view that the markets are currently in a risk-on phase and may be going to stay for a while. So no matter if you are a day trader or long-term investor, analyzing if markets are currently in a risk-on or risk-off phase can greatly help you in avoiding the wrong positions and improve your own trading decisions. If you enjoyed today's video, please leave me a like and make sure to subscribe to the channel. Until we see each other again next time, happy investing.